Thank you so much for joining me. My name is Billy Keels. I'm the founder and CEO of Keep On Cashflow. And in this very brief video, I want to talk to you about the 4 ways that you can make returns in real estate. And the reason I'm answering this question is I get it quite frequently. See, being an American who lives overseas in Europe and invests back in the United States, people always want to ask me, or people always ask me, Billy, why is it that you are investing back in the States? And well, specifically in real estate. And well, a lot of the reasons have to do with these 4 specific reasons that I want to share with you. And this will help you whether or not you are looking to invest in your own projects or you're looking to invest in other people's projects. Once again, the whole point here is to continue to help educate you. So let me go ahead and talk to you about the 4 different areas that you can use to create returns for yourself in real estate. The first is an area known as appreciation. Now, a lot of people talk about buying a house today, and then in the future, you may talk about selling it. And so, they always say the price of always goes up. Well, did you actually know that there are 5 different ways that you can create appreciation or create value as it relates to appreciation within your real estate deal? Let me talk to you about what these are. There's actually 5 types. There's what's called found, forced, phased, passive, and inflated. So what do each of these mean? Let me give you a couple of examples. For instance, if you're able to go out and negotiate very well. Let's say you find a property, you're able to negotiate very, very well. The difference between what is the asking price and the purchase price is the found appreciation. So you've been able to negotiate that very well. That's what that is. Forced appreciation is, let's say you're going in, I think the best example to give you is when you're thinking about buying a multifamily building, which is something that I love to do, and you want to go in and you want to restore all the countertops, or you want to change all the kitchens so that you're actually forcing on the property an improvement. So you are creating a forced appreciation play. And then lastly, one of my favorites is the phased appreciation play. This is really about change of use. So when you go into an apartment building, once again, let's say maybe you take out 2 of the units and you want to create or turn them into a coin-operated laundromat or a childcare center or something of that nature. So you're changing the use of the existing structure. Then there's the next 2, and let me tell you about the next 2. So the passive just means that someone's willing to pay for the property because of some kind of emotional reason, because it was on your favorite street when you were younger or your aunt's favorite street. And then next is inflated. And this really has a lot to do with the Fed or the central banks. And the fact that they're printing more money makes the value of the property go up because it's inflated because of the amount of money. So, and I put these in red for a reason, because actually as an investor or someone who's looking to place your capital, you can't control, and I can't control passive, nor can we control inflated. But I did want you to be very clear about the 5 different types of appreciation that you can use to create returns for yourself or looking to create as you're placing your capital in other places. The next area of the 4 is depreciation. Now, depreciation, especially for those that are in the US, this is something that's really important, because this is what I like to call your tax incentives play. So this is helping to bring down your tax or help to offset some of your tax liability. So it's tax incentives. I think I spelled that right, incentives. And specifically, this is over real estate, but also too, if you want to look in like the tax code, section 179 of the tax code, it talks about different types of equipment or assets that can be depreciated over time. So that's also one of the, like I said, really relevant for those of you that are in the States, but once again, it's a tax incentives play. So this is also another way where you can create a return for yourself when you are deploying your capital. The next area is through what we like to call amortization. Now with amortization, this is what I want to talk to you about. It's called a principal pay down. So basically, when you look at amortization, so someone who's going to be the bank, whenever you're repaying any type of debt that you have against an asset, there are typically two parts. There's the principal and the interest. And so as you're paying the debt, repaying the debt over time, typically you will owe less. And so that is the amortization play. Once again, this is an area where you are creating a return for yourself. And probably if you're watching this video, and you probably are, well, or if you are, I should say an accounting or finance person, you're probably thinking to yourself that this is more of a balance sheet play. Yes, you're absolutely right. And for those of you, if that kind of went over your head, don't worry about it. We'll talk about it in a later video. But this is the area of principal pay down, talking about primarily principal and interest. And then the last area is the area that you're probably thinking about, and this is the one that most people talk about, and this is the area of cash flow. And usually when you're talking about your return, you're talking about what I would like to call the cash return on investment. And in this area of cash flow, I just want to really quickly at a high level help you to understand what we talk about with cash flow. So when you have a multifamily building, which is something that I love, for instance, you'll have on one side, you'll have rents, and those rents are also known as revenue. And once you have the revenue, you also have a number of expenses that you need to account for. So you have those expenses, which brings you to something that we call in real estate is the net operating income. For those of you who are, in the corporate world, you've probably heard of this, something as EBITDA, but it's the same stuff really, or very similar in that they both look at the efficiency of which you operate your overall project or your asset. And typically we're also going to go out and look for some type of a mortgage, so debt service. You need to take out the debt service as well. And then that brings you to your last line, which is your net income, also known as cash after debt service. So, as I mentioned, get the question a lot, and I wanted to just at a very high level talk to you and show you the 4 different areas where you can create returns for yourself, either operating or controlling your own deal or placing your capital with others' deals. So once again, the idea is to help educate you, show you the types of returns that you can make through real estate. I'm also going to be showing a couple of other videos, and we're going to go into each one of these in much more detail. So the idea is, once again, is to help you to understand how real estate can help you to create returns for you. I'm going to dive into this in a couple of other videos. As always, my name is Billy Keels. I'm the founder and CEO of Keep On Cashflow. That's my 2 cents for today. And as always, hasta la próxima.